Hey folks, your accountant Mansoor Suhail, Manny. I operate out of Scarborough, Ontario, and my specialization is tax for Canada and USA. My this presentation is for educational purposes only. It does not constitute any legal advice or opinion. Please do not use any of its contents without seeking a professional advice. I will be talking about the balance sheet today. So what is a balance sheet? The balance sheet is a measure of company's position at a certain given time. The balance sheet consists of assets, liabilities, and shareholders' equity. So formula for the balance sheet is assets equals liabilities plus shareholders' equity. Let's talk about assets. An asset is a resource held to produce some economic benefit. Cash, inventory, accounts receivable, equipment, and property are examples of assets. Assets are classified as current assets and non-current assets. Current assets. A current asset will have an economic benefit within a year. Examples of current assets. Cash and cash equivalents. Cash is currency in hand. Cash equivalents are money market holdings, short-term government bonds, treasury bills, and marketable securities. These kinds of assets can be easily liquidated. Accounts receivable. We recognize revenue from sales made on credit. An asset, account receivable, is recorded for the amount of sale. Let's look at an example. We made a sale of $100. Let us see its effect on the income statement, cash flow, and balance sheet. Our ledger entry will be accounts receivable will be debited, sales will be credited. Effect on income statement. Revenue is 100. Let's say our tax rate is 40%. So 40 gone for taxes and net income is 60. Cash flow. Net income will be 60. Change in accounts receivable is a negative 100. Total change in cash is a negative 40. Balance sheet. Cash will be negative 40 and accounts receivable is 100. Retained earnings, net income will be 60. When customer pays finally, our cash flow and balance sheet will look as below. Cash flow will be zero. Net income will be zero. Change in accounts receivable is 100. Total change in cash 100. Balance sheet. Cash equals 100. Accounts receivable will be negative 100. Retained earnings, net income will be 0. Inventory. Inventory purchased on cash is recorded as below. Inventory is debited. Cash is credited. Upon sale of goods, we record revenue and value of inventory is reduced. Following transaction shows reduction of inventory. COGS, cost of goods sold, will be debited. Inventory will be credited. Let us assume we have purchased inventory for $50. It will have following effect on cash flow and balance sheet. Cash flow is equal to 0. Change in inventory is negative 50. Total change in cash is negative 50. Balance sheet. Cash negative 50. Inventory 50. Retained earnings, net income will be 0. If there is a decrease of inventory by $50, it is shown as an expense of cost of goods sold. This yields net income of negative 30. If an asset is sold, it will increase cash when added to minus 30, and total change in cash becomes $20. Income statement. COGS will be negative 50. Tax at 40% will be 20. Net income will be negative 30. Cash flow. Net income will be negative 30. Change in inventory is 50. Total change in cash is 20. Balance sheet. Cash equals 20. Inventory is negative 50. Retained earnings is negative 30. Prepaid expenses. If an expense is paid in advance, it will create an asset. For example, let us say we prepay rent of 100. How would it affect cash flow? Cash flow is net income equals 0. Change in prepaid expenses is negative 100. Total change in cash is negative 100. Balance sheet. Cash equals negative 100. Prepaid expense equals 100. Retained earnings net income equals 0. When expense actually incurs, it is expensed in sales, general, and administrative account. So income statement will have SG&A equals negative 100. Tax at 40% is 40. Net income is negative 60. This net income of negative 60 flows into retained earnings. Cash flow will become net income equals negative 60. Change in prepaid expense is equal to 100. Total change in cash equals 100. Balance sheet. Cash equals 40. Prepaid expense is negative 100. Retained earnings net income is negative 60. Non-current assets. Non-current assets are not expected to convert in cash within 1 year. Property, plant, and equipment are examples of non-current assets. Intangible assets. We cannot touch an intangible assets. We cannot touch an intangible asset. Patents, trademarks, copyrights, goodwill are examples of intangible assets. Liabilities. Liabilities are debts of a corporation. There are two types of liabilities, current and non-current. Current liabilities are companies' debt or obligations that are to be paid within 1 year. Accounts payable is one of the examples. Accounts payable. So if a company purchases $500 in raw material on credit, the company will have an accounts payable of $500. Entry. Raw material will be debited, accounts payable will be credited. Cash flow. Net income will be 0. Change in accounts payable is 500. Total change in cash is 500. Balance sheet. Cash equals 100. Accounts payable is equal to 500. Retained earnings net income equals 0. When accounts payable is paid, it reduces the balance in accounts payable. Entry. Accounts payable is debited. Cash is credited. Accrued liabilities. Accrued liabilities are expenses that have been incurred but not paid. Let us say a company receives a utility bill of 1,000. Entry will be SG&A account will be debited. Accounts payable will be credited. Effect on the income statement. SG&A is negative 1000, taxes at 40% 400, and net income will be negative 600. This net income will flow to cash flow. Cash flow will have net income as negative 600. Change in accrued liabilities equals 1000. Total change in cash equals 400. Balance sheet. Cash equals 400. Accrued liabilities is 1000. Retained earnings net income equals negative 600. Accrued liabilities will reduce when the bill is paid. Entry will be accrued liabilities debited and cash will be credited. Cash flow. Net income equals 0. Change in accrued liabilities is negative 1000 and total change in cash equals negative 1000. Balance sheet will look like this. Cash negative 1000, accrued liability negative 1000, retained earnings net incomes 0. Short-term debts. Short-term debts are that come due within 1 year. Non-current liabilities. Non-current liabilities are debts that are due beyond 1 year. Following are examples: long-term debts, deferred taxes. Folks, this information comes from Financial Modeling and Valuation by Paul Pignataro, published by Wiley, USA. Thank you for listening.